Good morning, it's Tuesday the 20th, I'm FX Plu and this is CurrencyTransfer.com's market update. The headlines of which are UK wage growth is driving interest rate expectations, there are a number of bearish factors lining up against the dollar, and the euro is relatively passive ahead of Italian elections. The hot topic this week is inflation. UK inflation, and specifically what pressures this may put on interest rate policy. Yesterday we saw sterling slip down beneath the 140 level against the dollar. This is ahead of tomorrow's UK wage data, which is being seen as a pivotal factor within the rate hike decision for May. On balance, looking back at the November rate hike, it's unlikely that the MPC expected any dramatic effect from a 25 basis point rate hike, and indeed it has done very little, with inflation remaining around the 3% level. However, market sentiment is currently feeling that a lot more drastic action would be needed to bring inflation substantially lower. However, with real wage growth still being in negative territory, Carney needs to be very careful about what his MPC squad goals are right now, because there's always a risk that it may choke off any small shoots of economic growth whilst we've still got Brexit uncertainties in the background. Yesterday, cables slipped to just over 139.50 and remained weak overnight. Looking stateside, despite tax cuts and increased public spending, the short dollar trade seemed to run out of steam a little and the dollar index came back from recent lows. The graph geeks on my side have been pointing at their charts, calling the dollar index up towards 89.80 in the short term. So watch this space and feel free to call them out if they're wrong. I'll certainly be leading the charge there. But meanwhile, with the US trade deficit so close to record highs, sort of decade highs, remember the words of Treasury Secretary Mnuchin back in Davos, where a weaker dollar would mean a more competitive US outlook for exporters. Of course, Donald Trump had to jump on these comments like a fat ginger ninja. He was so keen to avoid damaging the US relations with both China and Japan, who are key debt holders of the US. However, there is some strong logic in that. A weaker dollar would be very beneficial for the US right now. At the moment, the euro remains a relatively casual observer of wider market events, sitting quietly in the wings, trading in a fairly tight range. Certainly against the dollar, euro dollar has been between 123.80 and 124.50 yesterday, and this is all ahead of the Italian election. Plenty of potential disruption to come, and volatility may ensue as we get closer to a week on Sunday. Any questions, any comments, pop them in the link below. Otherwise, I wish you a great day and I'll see you again tomorrow. All the best.